Welcome to the world of investment, where risk is the name of the game. Today, we're setting the stage for a captivating journey through the labyrinth of risk management, focusing on two of the most prominent players on the investment stage, stocks and cryptocurrency. The world of investment is as diverse as it is dynamic, with stocks and cryptocurrency representing two distinct species in this financial ecosystem. Each possesses its unique blend of risks and rewards, its own volatility, and its own set of rules. Recognizing these differences is the first step on the path to effective risk management. Whether you're navigating the long-standing tradition of the stock market or venturing into the relatively uncharted waters of cryptocurrency, a clear understanding of the terrain can equip you with the tools you need to manage risk effectively. So, strap in and get ready to delve into the fascinating comparison between the risk management of stocks and cryptocurrency. First, let's take a look at stocks, the traditional players in the investment game. Stocks or equities are essentially tiny pieces of ownership in a company. When you buy a stock, you're buying a slice of that company's future profits and growth. Pretty cool, right? Now let's break it down. Companies issue stocks to raise capital for various reasons, such as expanding their business, paying off debts, or funding research and development. As a stockholder, you're entitled to a portion of the company's earnings and assets. This can come in the form of dividends, which is a way companies distribute a portion of their profits to shareholders. However, the real allure of stocks lies in their potential for capital appreciation. If the company does well, the price of the stock goes up, and you can sell your shares for more than you paid for them. That's how you make your money work for you. But here's the kicker. Stocks are not a guaranteed ticket to wealth. They come with their fair share of risks. One of the most significant risks is market volatility. The stock market is a living, breathing entity that reacts to a myriad of factors. News events, economic indicators, and even sentiment can cause the price of a stock to fluctuate, sometimes wildly. Additionally, the performance of the company itself can greatly impact the value of your stocks. If the company performs poorly or worse goes bankrupt, the value of your investment can plummet. Similarly, broader economic conditions can also impact stock prices. Factors such as inflation, interest rates, and geopolitical events can all influence the overall health of the stock market. So, while stocks have historically offered attractive returns over the long term, it's important to remember that they're not a surefire way to wealth. They require careful consideration, research, and most importantly, patience. While stocks are a time-tested investment avenue, they're not without their risks. Now, let's shift our focus to cryptocurrency, the digital currency that's taking the world by storm. Cryptocurrency, in essence, is a digital or virtual form of currency that uses cryptography for security. It's like money, but in a digital form, and it's been making quite a splash in the financial world over the last few years. But what makes cryptocurrency unique, you ask? One word: decentralization. Unlike traditional currencies which are controlled by central banks, cryptocurrencies are decentralized. This means they are not governed by any central authority, like a government or financial institution. Instead, they operate on technology called blockchain, which is a distributed ledger enforced by a disparate network of computers. Now, while the decentralized nature of cryptocurrencies brings about a certain level of freedom, it also introduces a whole new set of risks. For instance, cryptocurrencies are known for their price volatility. The value of a cryptocurrency can swing wildly in a very short time, making it possible for investors to experience significant gains or losses. Regulatory news also plays a big role in the crypto market. Since cryptocurrencies are relatively new, governments around the world are still figuring out how to regulate them. This can lead to sudden changes in the value of a cryptocurrency when a government decides to regulate or ban it. Technological changes can also influence the value of a cryptocurrency. As new technologies emerge, they can make certain cryptocurrencies obsolete or enhance their value, adding another layer of risk for investors. Lastly, we have the risk of market manipulation. Since the crypto market is relatively small compared to traditional financial markets, it's more susceptible to manipulation. This can lead to artificial inflation or deflation of a cryptocurrency's value. In conclusion, while the potential for high returns may be tempting, it's crucial to understand that investing in cryptocurrencies comes with its own set of risks. As you can see, cryptocurrency presents a whole new set of risks, distinct from those in the stock market. Having understood the risks, how do we manage them? Let's start with stocks. Risk management in the stock market is not about avoiding danger completely, but rather about understanding it, measuring it, and taking calculated steps to mitigate it. Let's talk about diversification first. This is a fundamental strategy that involves spreading investments across various securities to reduce exposure to any single asset. Think about it as not putting all your eggs in one basket. It's about balancing your portfolio with different types of stocks from various sectors. If one sector or stock fails, others may perform better, offsetting the loss. Another important strategy is setting stop-loss orders. These are designed to limit an investor's loss on a position in a security. Basically, it's a predefined point at which you'll sell a stock if it drops to that level. It's like an insurance policy against significant losses. Finally, we have regular portfolio reviews. This is a proactive measure that involves routinely checking your investments to see how they're performing. It's about reassessing your financial goals, analyzing market trends, and making necessary adjustments. However, it's important to remember that these strategies are not foolproof. They require knowledge, experience, and a keen understanding of market trends. For example, diversification can limit your losses, but it also caps your gains. Stop-loss orders can protect against rapid declines, but they can also lock in losses if the stock rebounds after being sold. Regular reviews can help you stay in tune with the market, but they also require time and effort. So as an investor, it's a balance. It's about understanding your risk tolerance, setting realistic financial goals, and being patient. Investing is not a get-rich-quick scheme, but a long-term strategy that requires careful planning and thoughtful decisions. Risk management in stocks is all about strategic planning and careful monitoring. Remember, the goal is not to avoid risks, but to understand and manage them effectively. But what about cryptocurrency? How do we navigate this volatile landscape? When it comes to digital currencies, risk management is a whole different ballgame. Cryptocurrencies are decentralized, meaning they're not regulated by a central authority like a government or financial institution. This lack of regulation can lead to greater volatility, making for a potentially rocky ride. So how can we manage these risks? The first strategy is diversification. In the world of investments, there's a saying that goes, "Don't put all your eggs in one basket." This is especially true in the case of cryptocurrencies. By spreading your investments across a variety of coins, you reduce the risk of a single coin's poor performance significantly impacting your overall portfolio. Next, consider setting limit orders. This is a tool that allows you to buy or sell a cryptocurrency when it reaches a certain price. So, if the market takes a sudden drop, your sell order can be triggered, helping you to avoid major losses. On the flip side, if a coin's price dips to a level you're comfortable with, a buy order can be activated, allowing you to snatch up the coin at a bargain price. Lastly, stay updated on market trends and news. Cryptocurrencies are heavily influenced by news events, whether positive or negative. A single tweet from a high-profile figure can send prices soaring or plummeting. By keeping your finger on the pulse of the latest news, you can make informed decisions about when to buy, sell, or hold. And remember, knowledge is power. Educating yourself about the cryptocurrency market and understanding the fundamentals of each coin you invest in can give you a significant advantage. In cryptocurrency, risk management requires a keen eye on the market and a finger on the pulse of the latest news. So keep learning, keep adapting, and most importantly, never invest more than you can afford to lose. This is the key to navigating the volatile landscape of cryptocurrency. So there you have it, a quick comparison of risk management in stocks and cryptocurrency. We've journeyed through the basics, understanding the unique nature of both asset classes. We've seen how the established world of stocks has its own set of risks, from market volatility to economic downturns. In contrast, the new kid on the block, cryptocurrency, comes with its own unique risks, from regulatory uncertainty to technological vulnerabilities. But remember, understanding these risks is only half the battle. The real key lies in developing strategies to manage them. Whether it's diversification, hedging, or simply knowing when to cut your losses, effective risk management can be the difference between success and failure in the world of investing. Thanks for watching. Remember, we are not financial advisors and you should always do your own research. Don't forget to like, comment, and subscribe for more insightful content. And hit the bell notification so you'll never miss an update from us.